Coming up on Market to Market, grain belt planters roll just ahead of Mother Nature's attempts to stop them. Urban, suburban, and rural pollution puts pressure on southern hospitality. And one farming community works on cleaning up its water supply. Those stories and market analysis with Mark Gold next.
If you want to go out to...
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, May 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Mother's Day is Sunday. It's likely a few farmers will make last-minute purchases from their tractor cabs after engaging the auto steer. This week, reports show click and order purchases exceeded their bricks and mortar counterparts. From cab, couch, or in person, retail sales climbed 0.4% last month. Removing shiny new cars and the fuel to run them, the index moved 0.3% higher. The price paid for those goods rose 0.2% in April. Without a quick bite at the local diner and gas for the trip, consumer prices rose only 0.1%. Field work is running just under the 5-year average as farmers dodge raindrops and wait for floodwaters to recede. Inevitably, nitrate levels will rise in nearby rivers and streams as water runs off farm fields and front lawns. In places like Florida, high phosphorus levels from all sources have been wreaking havoc on the environment and putting a drag on tourism, the Sunshine State's #1 industry. Farmers may get the blame, but city dwellers are being put under the same microscope. Colleen Bradford-Krantz has the details.
Florida's Indian River Lagoon, one of the country's most biologically diverse waterways, is facing intense algae blooms resulting in fish kills and other ecological problems. The suspected culprit? Increased phosphorus runoff correlated with a population and construction boom in the surrounding southern Florida region. The Indian River Lagoon runs 156 miles along Florida's Atlantic coast, a high-growth area in a state that has seen more than 1 million acres shift from agricultural use to urban development in 15 years. The lagoon has been repeatedly choked with oxygen-robbing algae fed by runoff from lawn and commercial fertilizer use, as well as other pollutants.
It's gotten much worse in the time I've been here. We didn't see harmful algal blooms in the past like we do recently.
Paved over expanses such as roads, driveways, and parking lots have allowed runoff to make its way into the lagoon more easily. It has also been fouled by wastewater treatment plants that discharge into the lagoon, sewage spills from plants during heavy rains, and leaky septic tanks.
So all of these land use changes result in more water use and usually more pollution.
Although the federal and state governments have spent hundreds of millions of dollars to heal the lagoon in recent years, an Associated Press examination found that pollution spiked, algae blooms spread, and fish kills worsened over the past decade and a half as Central Florida's population swelled faster than that of anywhere else in the state. Water quality data analyzed by the AP showed that the average level of phosphorus, a byproduct of fertilizers and human waste that algae thrive on, rose nearly 75% between 2000 and 2016. Average chlorophyll readings, used to measure the presence of algae, almost tripled. According to the South Florida Water Management District, farmers further south in the 477,000-acre Everglades agricultural area have reduced phosphorus runoff levels by 27% in the past year. This exceeds the 25% cut mandated by the 1994 Everglades Forever Act. However, environmental groups continue to blame agriculture as a contributor to the problem.
100% horror.
The algae blooms often surround Captain Rufus Wakeman's charter fishing boat at the dock. He says the site is hurting tourism and fishing.
People are hearing about it all over the U.S., and they're spending their money other places. They're not coming here.
Over the past 2 decades, the annual value of the clams, oysters, crabs, and shrimp caught along the lagoon has plunged from $20 million to $4.3 million.
Our fishing guides, all my friends who are guides, they're not getting, the amount of traffic that they used to get. And, it's taken its toll.
Senator Bill Nelson is working on a partial solution. When Lake Okeechobee water levels get too high, dirty water is released into the lagoon, leading to many of the current issues. Nelson is trying to secure funding to filter the lake water and divert it to the south, into the Everglades.
So the idea is to cleanse that water as it comes south without putting it to the east in the St. Lucie River and the Indian River Lagoon.
It will cost billions of dollars and take decades to implement. But those who make their living on the water are unsure how much longer they can wait for change. For Market to Market, I'm Colleen Bradford Krantz.
In Nebraska, farmers irrigate more acres than any other in the nation. They routinely tap the High Plains Aquifer, the nation's largest freshwater supply. It is also the state's primary source of drinking water. Over the years, fertilizer application has made parts of the aquifer unsafe to drink. One town in Nebraska is seeing the problem firsthand and is working to balance legal efforts and land stewardship. NET Nebraska and Harvest Public Media's Grant Gerlach has the specifics in our cover story.
Planting is underway for Bill McLeod on his farm in central Nebraska. He's been raising corn and soybeans here his whole life. Back when he started, McLeod says farmers thought differently about the best way to use nitrogen fertilizer to make their crops grow.
Everybody kind of understood that a little was good, a lot might be better.
You could always put on more, but in the soil, nitrogen fertilizer turns into nitrates that can leach into the groundwater. And in high doses, nitrates are dangerous for health, especially for young children and pregnant women. Unfortunately, decades of old farming habits have left a troubling legacy. In this area, the subsoil is loaded with nitrates from fertilizer, and there's no place for them to go but down, into the aquifer. Here's what's happening. Farmers put nitrogen fertilizer on their fields. In the soil, bacteria convert it into nitrates that are taken up by roots to feed plant growth. But when there are too many nitrates, water from rain or irrigation carries the extra nutrients past the point where roots can reach, and eventually to the aquifer below. The aquifer is moving like a slow river. When the nitrates fall into the groundwater, they move too, and they build up. Here in the High Plains Aquifer and others, there are pockets of nitrates pushing far past the legal limit of 10 parts per million. In central Nebraska, a pocket of high nitrate water is flowing right toward the wells where the city of Hastings draws its drinking water. It's a looming problem for the city's residents and for Marty Stengy, the environmental supervisor for Hastings Utility System.
They're 5 times the drinking water standard. So those are some really areas of high concern for us.
Stengy and his team are building a unique line of defense.
Basically, we're going to catch the nitrates coming into the municipal wells.
They'll use strategically placed wells like this one to act almost like a filter for the aquifer, skimming off nitrates as they move toward the city. Stengy knows that nitrates tend to collect on the top of the aquifer, so unlike most wells, this one pumps from the top, middle, and bottom all at once.
So the top water, the highest nitrates, it'll go off and be treated.
And then that clean water that's retrieved from that treatment process then will be mixed with this bottom water.
And go back underground.
And it'll go back underground. But you have to pump them all at the same time to make it work.
Clean water will be pumped back down into the aquifer, so the high nitrates never reach the wells that supply Hastings residents. High nitrate water left over from the cleanup will be sent to a storage lagoon and used to irrigate and fertilize this field. Nitrates that would be harmful to humans can be safely absorbed by this alfalfa.
So as the plants are growing, they will consume up those nitrates. So we're going to take lemons and make lemonade.
Stange says Hastings will spend $46 million to complete the system, a lot for a city of just 25,000 people. And if the problem gets worse, they'll have to spend a lot more for a full-scale nitrate removal plant.
It's not cheap for large communities either, certainly, but it's often difficult for small communities to put in adequate treatment.
Karen Flournoy says pollution from nutrients like nitrates is a nationwide problem, causing blooms of toxic algae from Florida to the Chesapeake Bay to Ohio.
It clearly is a national problem. Now, the sources may be a little bit different in other parts of the country. They might have a much higher mix of urban stormwater than we do here, but it's still a significant issue.
But engineering only provides short-term solutions. Back in Hastings, if the water is going to be safe long-term, farmers will have to make lasting changes. Farmer Bill McLeod already uses fertilizer differently today compared to when he started.
Nowadays, liquid fertilizer that is not that cheap, and so we're trying to watch our pennies and just use what we need to out here.
Farmers are motivated by more than money. McLeod and others are being asked to do more, even if it's not by choice. Groundwater districts around Hastings have put additional rules in place to manage fertilizer use. McLeod says farmers have mixed feelings toward the rules.
We are doing it, because we care and everything, and that we're required to do it, too. And it's for future generations, it's just not us. My grandkids are going to be in this area, so they've got to live with the stuff that we're doing out here today. So, that doesn't bother me quite so bad then to comply with some of these rules when you think about the future, I guess.
McLeod says farmers don't like the extra paperwork or restrictions on how they farm, but he says they do want clean water for their neighbors, their crops, and for their own homes. For Market to Market, I'm Grant Gerlach.
Next, the Market to Market report.
Official reports of lower than expected ending stocks were outdone by bearish export sales and price pressure from South America. July wheat fell a dime, and despite gaining ground across most sessions this week, the nearby corn contract moved sideways. A slightly stronger real was unable to shake the grip of lower prices as the July soybean contract dropped 10 cents. May meal declined $3.60 per ton. In the softs, July cotton stopped its slide, putting on $4.41 per hundredweight. Over in the dairy parlor, June Class 3 milk futures gained 34 cents. In the livestock sector, Friday's gains were not enough to offset the week's losses as the June cattle contract shed $3.12 and nearby feeders lost $1.60. The June lean hog contract improved $1.62, continuing a late April run where prices have surged 14%. In the currency markets, the U.S. dollar index rose 60 basis points. Crude oil gained $1.57 per barrel. COMEX gold poured on an extra 80 cents per ounce. And the Goldman Sachs commodity index added more than 7 basis points to finish the week at 379.45. Here now to lend us his insight on these and other trends is one of our regular market analysts, Mark Gold. Mark, welcome back.
Thanks. Nice to be here, Mike.
Well, we're always glad to have you. But before we get started, you can listen to our market discussion anytime by downloading our market analysis and Market Plus podcasts on our website, iptv.org/MTOM.
And we have to say Happy Mother's Day to all the mothers out there.
We certainly do. And hopefully you're not watching this on Sunday, and that comes as a shock. Well, speaking of coming as a shock, was there anything that really jumped out at you in this week's WASDE reports?
Well, I think the 17-18 bean carryout, 92 million under what they were looking for, is certainly a surprise, but it did nothing for November beans. We actually traded lower. That was a big surprise that the market didn't react to. The fact that these corn and wheat world carryouts are still pretty big, the beans are still pretty big, that certainly stood out. I think we all know that there's a lot of crops around the world. We have no shortages, which is why we've got these cheap prices out here. But we've also got fairly strong demand, even unprecedented demand. Certainly they're looking forward in the bean market to exporting a lot of beans and a lot of corn. Unfortunately, we also found out that Mexico is getting their corn not from the U.S., but from other places, mainly Brazil, and that's a big drain off the market.
You bet. Now, one of the things that some folks have talked about is they don't believe the USDA dropped expected harvest on the wheat crop, given that massive blizzard that came through. Were you at all surprised by how much wheat was left in the report?
You know, I believe that we've done more damage. You know, I agree, wheat is a weed, and that's the common saying around, and it's going to grow through no matter what. But we've thrown really all growing season, some really bizarre, the dry, the fires,
yes,
the snow, the ice, the freezes. I just find it hard to believe that we're going to be as close to trendline yield as what the government's looking at. And, you know, this last round of this cold weather, you know, the numbers in Kansas are certainly down on the crop ratings, but I don't know if it's enough, and I think overall, even in some other states, we could see more reductions yet.
Is that going to be enough to really move this wheat market, I mean, north of 450?
It hasn't been so far, but we have to keep in mind the funds are still short about 130,000 contracts, which could be a bearish, bullish input going down the road. If we can get some spark for these funds to get out, we came close. We couldn't quite get there, and we backed off again, but hopefully we'll see the funds come in relatively soon.
Now, we've talked a lot about the fund placement in the wheat market as well as in the corn market. They've been very short the corn market. Yeah. Is that starting to turn? Are we on the cusp of a story that could get them to spark a little sell covering rally?
You know, it looked like we had a chance with the wet weather, but the last couple of weeks, and last weekend, we had some chances. Last few days, we've had some chances. We saw in the weekly progress reports that we're basically on average. We got more work done, and I think a lot of work done this week. So that story's kind of out of it now. The funds are short about 170,000 corn. Eventually, that could be a story, but again, we need a spark. And at this point, if it's not going to be delayed plantings, you know, are there going to be some replanted acres? Yeah, but the market knows about all that. It hasn't done anything. And we have been stuck in this 20-cent range in the corn really since October, November, and we can't shake out of it one way or the other. I'm hoping that as we get into the growing season, something will chase us out to the upside and force these funds to cover.
Now, for producers that are sitting there like so many producers are, with bins full of old crop corn and need some cash, you need to make some sales, do you just sell the physical and just clean out the bin? Do you wait a little while? How do you handle any sales?
You know, that's a great point. Nobody really, all the analysts that I take a look at, nobody's really talking about how much corn is still in the American farmer hands, and I believe there's still a fair amount of corn out there. So that's kind of a Damocles sword hanging over these markets. But the fact of the matter is we know that they're going to be forced to move it one way or the other in the next couple of months. If there's carry in their local markets that pays for the storage above and beyond that, go ahead and capture that carry. If you've got to sell it at these lower prices, I'd certainly look at buying some kind of call option to replace it. The call, you can get something out there for a dime, 15 cents to keep the upside open, which is probably cheaper than storing the grain.
Would you just look at a September call, or where would you go?
I wouldn't go all the way out to December. I think we'll know long before that whether we have a market or not. So
okay.
A September might not be bad, even an August call to get us through that July weather. See if we've got a chance to pay off out here.
All right. New crop, you just a sit and wait kind of guy? Are you buying puts to protect against lower prices, or do you think we're at the bottom here?
Well, we had an opportunity this week at Top Third. We had a recommendation that got hit on the report day. When we had that spike up, it was there for a matter of seconds. Yeah. Guys that had orders in at the elevator got filled on those orders, but it was only 5% of our guaranteed bushels. We've been making small sales for the last several months. But for the corn that we haven't sold, we have put options underneath. Again, I don't believe you have to go out to December. They could hit this corn market hard in the next 6 weeks if they believe the corn's getting in, that the old crop corn's got to come to market. So I think you really don't need to go out past August on some of these puts to protect this downside out here.
All right. Looking at the soybean market, we've got kind of the inverse situation with old crop. Most American farmers have sold it off. Are we still waiting on a lot of South American farmers to sell?
Well, they're pretty much done. I think Argentina now was at 70% of their harvest.
Okay.
I think a lot of that pressure's kind of alleviated itself, but we're still looking at these big bean acres coming through, or it's going to be a toss-up, corn bean acres, which one's going to be bigger this year. And if we do have anything close to trendline yield, we're going to have a carryout in beans. You know, we're down to 440 now, but could it go right back to 540? It certainly could with the right yields. So I think there's still a lot of risk in this bean market.
Well, now, and that sets us up. We've got a question here from one of our Twitter followers, and we encourage all of you to look us up on any social media. We're on Twitter, Facebook, and Instagram. Just search for Market to Market. This one comes from Minda on Twitter at GrainsGirl. She's asking, assuming a benign growing season like we just talked about in the U.S., where do you think the bean-corn ratio, price ratio, will be in October? If we go back to $5.50 on a carryout and corn stays pretty much what USDA anticipated.
You know, we're at a 2.5, give or take, corn-bean ratio. I think you've got to go back to 2.1 or 2 point or maybe even lower than that. Okay. You're going to really have to discourage bean production if that's the case. And the only way to do that is to make corn a little bit more viable. But I think, you know, if we do have benign weather, we have a big corn crop, a big bean crop, we're having trouble with the export markets, we're going to need something to step in and change that. Now, we saw a Chinese deal on the beef. Can we see a Chinese deal on the grains? You know, I was around in '73 when the Russians took that grain. What seemed to be, you know, it was a great deal. They took it at the lows, and then we rallied straight from there. You know, hopefully somebody will come in and take this grain. But without all that being said, you've got to look at the beans losing ground to corn if we have benign weather.
Okay. All right. Now, you talked about the beef market. We did have news on late Thursday into Friday that China will be accepting U.S. beef by July 16th. Yeah. So it's the first kind of hard numbers we've had. Friday, we saw those deferred months in cattle and feeder cattle go limit up. Yeah. Was that just in response to that Chinese announcement?
Well, you know, this has been in the market for the last 3 weeks, which has caused this tremendous rally that we've had in both fats and feeders. Everybody's kind of been getting set. The funds are heavily long, the live cattle market. So is it a case of, you know, buy the rumor, sell the fact? We put in some highs here a week ago. We've certainly recommended on a $40 rally in these meat markets to be buying puts to protect the downside. Guys say, well, I don't want to spend $5 100, but they'll watch $4.50 go out the window in one day on a limit down move, and they don't think anything of it. So we're still at a great level here, well worth protecting. Let's hope the Chinese come in and buy whatever they want, and we go to 180, 190 feeders and 160, 170 fat cattle. We'll lose the money on the puts and gain it on the cash. We won't have any margin calls to deal with. We'll live with we love the higher prices, but if this thing is sell the fact, buying these puts can be great insurance for you.
Do you think we'll know by next week if this is a sell the fact situation? We got the spike on Friday. If it's sell the fact, we'll start to waterfall it on Monday, would you imagine?
Well, there's a little gap on some of the charts out there. Maybe we go up, open a little higher on Monday. We'll see how we act on Monday. If we could close higher again on Monday, then maybe we wait and make the highs the last Friday of the month, which is typically when we would do it, maybe before the long weekend.
Okay.
So we could have some more upside yet. But I'm really very hesitant about saying that because we've come so far so fast. We've got the announcement. The cash and the futures have been so far apart. Something's got to give there. And I think we'll see the futures come up a bit and the cash come down a little bit.
We've seen that rubber band stretch.
About as far as it can go.
Yep. Where's the end? Now, the next thing I want to talk to you about is the pork market. We've seen pork be gripped by this we have so much supply conundrum, and yet it still seems to be moving at the retail level. We still see lean hogs upper 70s. Where do we go from here?
Well, I think the $80 wall is the question. We have bumped up against $80 on these summer months hogs, I don't know how many times in the last 8-10 months. If we could ever close solidly over $80 in July or August hogs, it opens up, you know, at least a dime higher, in my opinion.
Push up towards 90.
Push up toward 90, and maybe fairly quickly out here. The question becomes, can we do that? So again, we've seen this rally in the cattle market, we've seen the rally in the hog market. Do we want to sit here and hope and pray it goes through 80, or do we want to protect it here, buy some puts? If we get to 89 or $90, we'll roll those puts up, spend another $1 or $2 to get that extra dime locked in. but I think you've got to be doing some marketing now by buying the puts.
Now, one of the complaints that I've heard from a lot of producers as they look at the options market in live cattle in particular, but also in lean hogs, the volatility has exploded over the past 3 weeks, which of course makes options a little more expensive to purchase. You believe that's still a better value than outright selling the futures?
Well, if they've got the futures, if they've got the animals and want to lock in those profits using the futures, I have no problem with that at all. But what I would do is back it up with a call option, because if we do explode and this Chinese thing really gets hot, you don't want to take those margin calls. You don't want to leave all that money on the table. So sell whatever futures you want. Go out and buy an out-of-the-money call for a couple of bucks just in case.
$10, $15 higher? Is that where you'd look?
I would think that would be reasonable. Just to protect yourself in case there's some major explosion. We've been to 210, 215 feeder cattle. We've been to 170, I think, in the high in the cattle.
Yeah.
So do we want to leave those profits potentially on the table? No. But if you've got an opportunity to sell cattle, either by moving the animals or by selling the futures, there's nothing wrong with that.
Okay. Manage that risk.
Manage the risk.
That's what it all comes down to. Well, Mark, thank you so much for taking the time to join us tonight.
Glad to be here. Thanks, Mike.
That wraps up the broadcast portion of Market to Market. However, Mark and I will keep the conversation going, including answering more of your questions during Market Plus, which is available in podcast and video form on our website. While you're there, check out the link to our Instagram page where we post photos from our journeys across America and behind-the-scenes adventures. Find us at IPTV Market. And join us again next week when we learn how one pork-producing family is cultivating fans in Japan. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.